Yes, Catherine.
Okay. You see, do you see the screen or wrong?
We see both. We see you and we see the screen.
Okay, thank you. So I'm going to share about four other investment options, right? So why I wanted to share this last year, for those that I was working with from last year, I shared that last year was like my financial literacy year where I learned a lot about money, but also because I was praying about my finances. I have never been that deliberate like last year. And through praying about my finances, that's how also I like to believe God started to lead me into the portfolio careers, right? Now Nicole gave it a term for me to understand, but I didn't know what it was at that point. Using your skills to make money. One of the things that I did, I wrote a book, and coaching and teaching and all those things. Then God started to make me learn about investments. And for me, I knew certain concepts, but I had to, I visited institutions. That's how I got the knowledge I'm going to share and how it worked for me and how I encourage you to, use it. So for me, I walked to these institutions. I didn't just sit and get taught as like, okay. I first started by going to the Uganda Securities Exchange. And I remember the first time I entered there, it's at Nakawa, that UAP building. I entered there. This gentleman met me. He's like, so, yeah, how can we help you? I told him I want to know how I can invest money. And he said something very profound. He asked me how old I was. And I told him my age. And he's like, that's very interesting because not very many people in that age group of yours think about investment. They think about how to make money and make more money and make more money, but they never think about how to invest it and how that money can actually work for them. So he decided to tell me how, the house, and he led me and all that. That's what I want to share. So I'll start this way. Ecclesiastes chapter 11, verse 2. Julie also had it in her presentation. It says that put your investments in several places, many places even, because you never know what kind of bad luck you're going to have in this world. All right, God forbid bad luck, we refuse bad luck. But the point is, put your investments in several places, right? Many places. Invest widely, invest in different things, because you never know when you need, the returns of that investment. So we are going to look at four investment options, the ones that have done, the ones that have done, right? And how they've worked for me. And you can start here. Anyone can start here. The very first one is unit trusts. I know you've heard about unit trusts. Yesterday, Leila said that her business has a unit trust. Julie told us she has a unit trust. People have started to learn about unit trusts. But what are unit trusts? So I'm going to teach like basic, as if basic principles, basic, like a layman. I want to teach like the way I was taught, layman. So a unit trust is where professional fund managers invest your money for you. So professional fund managers, for instance, UAP, Britam, ISEA, those are the professional, fund managers. They invest your money for you and they give you a profit based on how much you invested. So you give them your money and then they invest for you and then you make a profit. So these companies, the Britams, the UAPs, the ISEAs, they take your money and they invest it for you, one in government bonds and bills, right? In bank deposits, in company shares, and other safe financial instruments that we may never know. So for you, when you give them that money, they collect it, they go and invest it somewhere, and then they give you a profit based on how much you have invested. That's what unit trusts are. So, what are the characteristics of a unit trust? Number one, a unit trust can be a personal trust for you, just you, or it can be joint. The people who have joint unit trust, maybe husband and wife, maybe siblings or whatever, a group of people. You can have it personal, you can have it joint. But today I'm just talking about, I'm really focusing on the personal one because we're talking about personal finance. I have a personal unit trust, but we also have a joint unit trust with my husband. So it can be a personal or a joint. And the name of the trust is always in the name of the owner or the owners, basically. Number two, you decide how much to invest in a unit trust. However, you take into consideration the minimum opening balance of the account. So these different fund managers, ISEA, UAP, Britam, my personal unit trust is in Britam and our joint is in UAP. But when you go to open up these unit trusts, there's always like a minimum opening balance, and usually it's 100,000 because for both it was 100,000. So that's the minimum opening balance. But then they also have a minimum deposit amount. For Britam, it's 20,000, if I'm not mistaken. For UAP, it's still 100,000. So you decide how much you want to invest. Yes, there's that element of you decide. But aside from the minimum opening, if you want to now keep on depositing, it has to be above that minimum. So for Britam, for example, even if I have 25K, I can deposit because their minimum is 20,000. Let me even first confirm it here a bit, but that should be it. Then number three, you can always add money at any time. That's the thing about a unit trust. You can always add money at any time. When you get your car money, you just keep adding. There is something that Julie has said that when it comes to things like saving, and she said that you should save in secure places, right? One of the secure places you can save is a unit trust. She said that save as you earn. So when you get like this car money, you can just put it there for as long as it's above the minimum deposit. I just want to see something just to confirm, to top up. Okay, let me see. These things usually have apps. Yeah, the minimum for Britain is 20,000. So number three, you can withdraw the money whenever you need it. But this also depends on your type fund. But generally, for a unit trust, you can withdraw the money anytime you need it, you can remove it. So when we talk about profits, remember we said that these people take your money, they invest it for you, and then they give you profit. So when it comes to unit trust, profits are usually within the range of 10 to 13% a year, depending really on economic factors or whatever. But these profits are broken down into daily profits. So if it's 10% a year, there's a way that you know how to break it down, yeah, to fit like a daily rate. So you earn daily on the money that you've put there. But again, like I said, the percentage depends on the different economic factors and further determined by the fund manager. So you may put money in a trust and the rates might differ. So one of the things that I've grown to do and I advise you to do is that have a relationship with the institutions that you put your money, right? And what that means that if it's a customer service, somebody or an email or whatever, keep asking questions. You can even just ask them like, oh, the year has started. So what could be the rate for this unit trust this year? So that you can sort of also know what to expect, right? So unit trusts also have compound interest rates. What that means is that, let me give an example, okay? So in year one, if the profit rate is 10% a year and you deposit 100,000, your profit will be 10,000. So 10% of your 100 is 10. That is there. So when we move into another year and you leave that same money there, your principal will now have become 110. And so the profit will be on the 110. For those who don't know what compound interest is. So it makes it like this time the profit you get is 11,000. So the profit is added to the principal and then the profit is given off that sum that is the principal, the original money and the profit. But however, not that the interest compounds daily. So this example I'm giving you is for the year, but remember that they break it down to give you a daily profit. So every time the daily profit is added to your principal, the next day, the percentage is taken, the percentage of profit you get is from this total now, which is the principal, and yesterday's profit. So it keeps compounding like that. So you see how Julie said that people said unit trusts are better than insurance is because for them they have a compound interest. I think that's what makes them also like have that high sell, not sell value, but like people really, really like them because there's that compound interest. You just don't get your interest and that's it. It's added to the principal, and the next time they are giving you profit, they've joined this to make it one. I hope I've explained that properly. So now, how much do you need to start? Usually the opening balance, like I said, is 100,000 Ugandan shillings, which means like anybody can start. When you're waiting to make it big, to save, to invest, you're not going to really ever do it. And 100,000 Ugandan shillings is something that anyone can get or can save, or I like to believe that the average Ugandan can get 100,000, right? So it's easy to start and it doesn't need a lot of money to start. And then if regular deposits also have a minimum amount as little as 20,000, which is for preterm, depending on the fund manager, it's quite easy to start. Like you don't have an excuse. If you get out of today's teaching and you still enter February, March, April, May, and you don't have a unit trust, you don't, to be honest, you don't have a reason, because it's not that you don't have money. You can find 100,000. If you can buy a shoe, people here, I know people, the ladies on, most of the ladies on this platform, they are women who have nice things and they're women who God has blessed. But if you can buy a shoe of 150,000, if you can buy hair of millions, and then you cannot open a unit trust. And now for instance, again, like Britain, as low as 20K, then that means you just don't want. Right. So let's talk about the risk involved. Now, when it comes to investments, all investments have risk, all of them. Anything that is investment has risk. However, unit trusts have low to medium risk, depending on economic conditions per time. So there are various economic conditions. I also want you to go back and read that affect rates of interest rates. So, but generally, it's low to medium risk. Insurance, on the other hand, has low risk, the one that Juliet was talking about. So anything that is really low to medium is good for anyone who is even starting. So how do you start? For those who are like, I want to start a unit trust, blah, 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 blah. You're going to choose a licensed fund manager. There's Britam, there's UAP, there's ISEA, there's Stanbic. I know there are others. What I want you to do, because this is how you'll become serious, look for their emails, send them emails, their customer services. But if you have time, walk into those offices. Those people don't bite. They don't bite, right? Walk into those offices, ask them, I want to open a unit trust. How do I do this? How do I do this? Let me tell you something that happened. One of the reasons that I was very motivated to open a unit trust is when we're opening the unit trust for the joint UAP, the gentleman who helped us open it told us that he has a client who, because we went there to the offices. So he has a client who has 500 million on his what? On his unit trust. And so if a man like that has 500 million on his unit trust, let's say the lowest that year they're going to give him is 10%, that's 50 million. That's how he pays his children's school fees. He doesn't have to think about, there are people who are, when school fees time is like, hell has broken loose, like, oh my God, I must look for money. Now the kids are going back. They are this, and you know how school fees is expensive. You find a child who's just in like P1 and they're paying 2 million Ugandan shillings, and the person has like 4 children, that's like 8 million. And this guy told us, this man, for him, he has that 500 million. And he knows that every year, and it's in a unit trust. I know that every year, remember, it's even compounding. Yeah, it's even compounding. So he actually gets more than 50 million, even if it's a 10%. He knows that he'll get this money and he'll pay fees for his children for a year. When I heard this, I was like, oh my God. So this man is those people who don't know that fees, even if they increase them, he's not bothered. Even if what he's not moving as, like, people have planned for their lives. So when we see people and And the things that shake you don't shake them is because they've planned for their lives. And I like to believe that if you start early, you can build up to, to that. So how do you start? Go to these people, get a form, talk to these people, ask them questions, fill out this form, then they'll give you an account, your unit trust, your details, blah, blah, blah. Many of them, I think all of them have mobile apps whereby you can track the money that you've put, you can track the interest that you get per day. Me, I always track, the interest. You can also, from there, you can withdraw, because you can, okay, your interest is linked to your bank. So when you want to withdraw, you can withdraw from your end on your app, but then the money will go to your bank in about 1 to 3 days. And then lastly, even as they won't demand that you deposit a certain amount per time, like unit trust, you deposit when you want. It's not like every month you must pay this amount. So even as they won't demand that you deposit a certain amount per time, just be disciplined enough to deposit regularly, right? Just know that if this is my salary, this is how much I get this month, this is how much my business produces. At least every month, let me put 100,000 to my unit trust. So these things have a lot to do with financial discipline. There is a lady, I think she's Reverend Funke Felix Adejumu. She keeps saying that if you eat with your 5 hands, if all that you get, you eat it, all the money that you get, you eat it, you have a problem. And that's true. Because the older you go, the more you realize you had to have saved money. And sometimes life is in season in such a way that maybe there's a season of abundance and you have so much money. And then the time, that the story, the Bible story of the fat cows and the lean cows, that dream that I think was the dream that led to the drought to the Egypt, when Egypt there was hunger and stuff. But that dream started with the seven fat cows and the seven lean cows. What do you do with your seven fat cows? What do you do at a time in your life where you're making a lot of money? You eat all of it. Then what happens when times come and you're in a lean season? So for unit trust, you honestly have no excuse. If you don't open one, sometimes you really just don't see the need. But understand that if God has given you the opportunity, part of stewardship is save this money and grow this money. And besides making you money while you're sleeping, you're not doing anything. It's just there. You just wake up and it's there. There's a sum of money I deposited in my unit trust, I think, in November. And then one day I just woke up and I saw after 2 weeks. For some reason, that money they deposited it after 2 weeks. Yeah. But I saw the profit that it had made in 2 weeks, and I was so happy in my heart. I was like, this is good. I haven't done anything to make this money. It's just there. So the advantages and disadvantages of unit trusts. The advantage is number one, you can withdraw this money at any time. So remember, and you can withdraw both the money you invested and the profit. Like you just take all of it, which is an advantage, but also a disadvantage because that's why you also have to have financial discipline. You know those things of girls' day out, like we are going out, and then you just withdraw the money because you can get it and use it for things that are not important. So it's both an advantage, in my opinion, and a disadvantage because you can access the money at any time. So if it's an emergency fund and maybe something happens and you need money, something really serious, you can get it. But if you're also the kind of person who just withdraws money because vibe, then that's an issue. That's why all of us have to either have accountability partners, pray for grace to have financial discipline. Number two advantage, unit trusts, it grows savings faster than a normal bank account because even if you put your money in a fixed deposit, I think the fact that unit trusts have that compounding aspect, money really grows faster that way. Number three, you can build money for future goals like buying land, etc. So you can save in a unit trust, you can save money for a future goal. You want to buy land, you want to buy whatever you want to buy. Number four, the advantage, like I said, it has compound interest, which is a bit different from most of the other investment types. That compounding interest is such a great thing that even on the profit that you get profit on the profit that you got because they add it to the principal and then you get, profit from that. Number five, it's regulated and safe. Yeah, it's regulated. All these things are regulated by the bank, like the governing financial institutions in every nation. Then number 6 is low minimum investment. Like I said, to open is 100,000. Then again, as little as you can get, you can keep depositing. So it's a low minimum investment. You can't say that because the simple said, I don't have enough, I can't earn enough, so I can't invest, so I can't save. But you can save 25K at least, right? The disadvantages of any trust is number 1, delays in cash outs. It takes usually 1 to 3 business days to get that money. Like I said, it's linked to your bank. So you withdraw on your end, but for it to reflect on your bank can take between 1 to 3 business days. So if you're like in a hurry, maybe there'll be that delay. Then also there's an inflation risk. Again, I said the economic factors that affect, that we don't see, because we are like the retail investor. I think that's the word. We're like the retail investor. They're the top guns and everybody else above us in the system. So there are sometimes economic conditions that could bring about inflation. So that could affect unit trusts. However, unit trusts are a place that you can start to save. The second place where you can invest your money are treasury bills. The Bible says in Deuteronomy 15 verse 6, the Good News Translation, that the Lord will bless you as he has promised. You will lend money to many nations, but you will not have to borrow from any. You will have control over many nations, but no nation will have control over you. Deuteronomy 28 verse 12, it says that he will send rain in season from his rich storehouse in the sky and bless all your work, so that you will lend to many nations, but you will not have to borrow from any. Now, let me first go to the next slide and then I come back to this. So what is a treasury bill? This is money that you lend government for a short period of time and government pays back with profit. Let me go back. Treasury bills and treasury bonds are ways we lend to nations. So I learned last year, because last year was my financial literacy, like core, because I'm still learning, but my core learning. One of the ways that we lend to nations is by buying bills and bonds. I learned this from Dr. Eunice and I think from Mrs. Morondo Manuela. They were sharing individually that how do you think we lend to nations? How do you think we lend to nations? It's by lending governments money. So the Lord will bless you as he has promised. You get, that is settled. The Lord has promised that he'll bless you. And because he will bless you, and after he has blessed you, you will lend to many nations. So all these things that we want to do, growing in business, making money, using our portfolio careers to make money, the goal is that the Lord will bless us because he has promised that he will bless the works of our hands. And then after that, you will lend to many nations, but you will not have to borrow from any. And you'll have control over many nations, but no nation will have control over you. So when you invest in bills and bonds, you're lending to your nation. When I went to the Uganda Securities Exchange, we had this conversation, and luckily, beautiful enough, this gentleman who taught me these things about bills and bonds is a born again. So we had a very beautiful conversation, right? And then I realized that God wants us to be lenders to nations. And it's the nation that you lend to that you have control over. Do you know, Dr. Innes said, no, Mrs. Monodo said that for her, because she invests in bills and bonds, she feels like she has a right to complain about roads. Because we're going to see why government borrows money. Because now it's like you have control over the nations. Like you even have a say. Like you can now legit have a say because you have lent them money to do things. So you can be like, hey, how come we've lent government money and they're not doing the things that they say they have to do? The Bible says that he will send rain in season from his rich storehouse in the sky and he'll bless your work, so that you will lend to many nations. One of the reasons God is blessing you is that you will lend to nations. It's one of the reasons God is blessing you. So we go back. A treasury bill is the money that you lend government. So you're lending a nation. The guy in USE told me, Ghana Securities Exchange told me that, do you know that you can also start to buy bills and bonds in other countries. Do you know that you can buy bills and bonds in Rwanda? That's what I'm saying. Sometimes just walk up to the offices. They won't bite you. Ask exhaustively. He's like, he told me something that made me sad. He said for the longest time, Ugandan bills and bonds were bought by people outside of Uganda, white people of different heritage who are not Ugandans. One, we are so ignorant. Oh my God. We are so ignorant as Ugandans. We just sit in our homes. What we know is enough. We don't care to know better. We don't care to grow. We don't want to pay the price for knowledge. So sad. He said it's now just a few years that Ugandans' eyes have started to open, that they can also buy bills. They can also buy bonds. He said very many people outside Uganda, white people, other nations have, because Uganda is a growing economy. And because an economy is growing, government needs money to grow the economy. But if you, the citizens, you're not buying the bonds, you're not lending, whoever is available to lend will lend. People have made money. I know someone, a gentleman who is old and retired now. He's, I think, 83. But how he's living now is because he has government bonds. One of the ways, because he also had other sources of income, is government bonds. He has a lot of money that is there. So he gets a very big sum of money every year. So government pays him a profit. Yeah. So treasury bills is when you lend money to government for a short period of time, and government pays back with a profit. So government borrows money to run the country. I don't know if you know. It uses that money to pay salaries, to build roads, to support services, and it borrows from the public. Those who don't know, it's the if you know, you know. So treasury bills are issued, auctioned, and backed by Bank of Uganda. And since they are short-term investments, usually invest for 3 months, that's 91 days, 6 months, 182 days, or 1 year, 364 days. And after the period of its maturity, you receive both the money you invested and the profit. So it's fixed. If you bring your money and you want to be here for 3 months, they fix it, they'll add a profit, and then they'll give you everything after the 3 months, all the time that you decide. All right. So who can buy treasury bills? Individuals like you. Treasury bills are not those things of rich people. That's a problem with, ignorance is bad. And one of the things that I fight is ignorance. Me, I used to hear, those things, and I think they're for rich people. And you think they're for rich people, like, hey, man, I got those. You don't even want to know, you're even scared of knowing. Yesterday, Leila said that many of us are scared of wealth. We're scared of wealth, we are scared of money, we're scared of the blessing, And that's how we behave. You can be like, ho, 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 ho. Those things are for rich people. You can buy treasury bills. You can buy treasury bills. Businesses can buy treasury bills. Circles, churches, investment groups. And let me tell you, people, even churches that have investment groups have learned these things. Those ones, they can boldly come and say that scripture is being fulfilled, that we are lending to nations, but you don't have any treasury bill, you don't have any treasury bond, and you are just proclaiming. You people, scripture is supposed to come alive, and there's always a way it comes alive. So treasury bills are low risk. I told you that every investment has what? Has a risk. So treasury bills have low risk. When it comes to profits for treasury bills, the profits range from 10% a year, even up to 14%, depending on the Bank of Uganda, the time of auction, and the economic factors at that time. So the thing about treasury bills and bonds is that the profit is simple interest, and it is fixed, unlike that of unit trusts. For instance, I didn't do the example, but let me just explain. So how we talked about unit trusts, for them, they compound. When it comes to treasury bills and treasury bonds, if let's say it's 10% a year, but it's usually higher for these things anyway, and you've fixed for a year a treasury bill for, let's say, a year, 364 days, and you've put 1 million, the 10% will be 100,000. That is what they will give you for the entire year. They will not compound anything. They will not do anything. It will be that money. However, the profits are taxed. The profits for these bills and bonds are taxed. And the taxes from unit trusts are usually lower and more friendly, if any. So unit trusts, their tax system, some are taxed, some it's like that. And these are questions you have to go and ask when you're opening a unit trust. You're like, okay, are we taxed? Because some will tell you they are not taxed. Then others maybe they'll tell you there's a withholding tax about what. Those are things you have to know. But usually the taxes, if any, imposed on unit trusts are much lower than those on the Treasury bills. However, like I said, for it has a simple interest and it is fixed. What they actually, when you go to buy a Treasury bill, because actually you still have a bill that's running that has to mature anyway in like 2 or 3 months, they'll give you when you purchase that Treasury bill, when you auction and they do the auction for you and they will tell you how much money you're going to get. So for me, I invested a certain amount of money and I know how much money I'm going to get. Like, it's not negotiable because it's not compounding. It's not what you will know that this is how much they're going to tax. This is how much you're going to get, and this is how much the fund manager also takes, because maybe, okay, for unit trusts, I don't know if it's the back end, if they do it back end, but when it comes to bills and bonds, because of the nature of what they are and the fund managers, they usually take off a fee. What do they usually call that fee? A transaction fee or something? Because they're the ones who do it for you. You don't buy the bill by yourself, right? You have to go to a fund manager, and they help you do it. So that transaction fee is like them doing that job for you. It's like a commission. They take off a fee, but it's usually really small. Anyway, so yeah, how to start? You're going to open a CSD account, Central Securities Depository, with a fund manager. I'm going to share about the fund managers. You're going to decide how much you want to invest and for how long. You're going to submit a bid through your fund manager. That's why I said that they remove a fee for commission, because you tell them how much money you have and the nature of bill. Is it 91 days, 182 days, 364 days? And then they will go and do the bidding for you when the time comes. So usually bids for bills and bonds happen twice a month, sometimes in the middle of the month and towards the end. So when you deposit your money through your CSD account to the fund managers, they wait until that time and then they bid for you. They submit for you the bid at that time, because Bank of Uganda is one that opens like on the 15th of whatever. And if the thing is, if you don't know, ignorance is bad. If you don't know, you will never know. If you don't deposit, if you don't know, so you don't know when do they buy bills, when can I resell? Like, you don't know these things when you're out of the system. So I want to encourage you this year, like, put yourself out there. Go and ask questions. No one is going to bite you. Go and ask. So they'll submit a bid for you. Then you wait for allocation, and then you hold until maturity. So after the bid has been sent, they will send you that form, like I said, which they sent. This is the money. This was a transaction money. This was the discount. This is a commission fee. This was a tax. This is what. This is the money you're going to get after maturity. Now, I don't think I put the part of the fund managers. Oh yeah, I did here. How to start. So fund managers for bills and bonds are banks, your local bank, because I said it's them that help you to buy. For you can't reach government. They are like your middleman. You need a middleman. So your local bank, sometimes you need to walk up to your bank and tell them, I want to buy a bill, I want to buy a bond. Then there are also brokers that you can reach. For instance, Crescent Stocks and Securities, there's UAP Old Mutual Financial Services, SBG Securities Limited is for Stanbic, Dyer and Blair, they are there. Go and do your research. Me, I want to teach you and also tell you to go and do your research. Go and do your research. So you can walk up to your bank and tell them you want to buy bills and bonds. You can go and look for these offices, UAP Old Mutual. You can look for Crescent Stocks and Securities. You can look for SBG Securities. When you reach there and then you open the account, ask them. What I want to tell you is that, okay, they say by the book that minimum amount that you need to buy a bill and a bond is 100,000. They say by the books. However, for me, for the broker that I use, for them, their minimum, which I like, for a treasury bill is 1 million. So for them, they can't buy for you a bill if you have anything that's less than 1 million. So why you also have to go and ask for these things, because internet will tell you different things, minimum, what. Some will say, I think some will say $100. Internet will tell you things. But when you go and you find out for yourself, for me, my broker, because I use a broker, not a bank. And why? Because I was recommended by that gentleman at the US. He told me it's better to use a broker, because for them, okay, they may deal more with the retail investor, but also your bank can work for you. Whatever you can access, not rocket science, nothing, whatever is comfortable for you. But me, I chose a broker. Yeah. But that broker of mine, you need a million shillings minimum to buy a bill. And a bond, you need 5 million minimum. So let me go back to this. So you see the use of unit trust, even if you have the desire to invest in a bill or a bond, because bonds are more long term. Do you know that you can invest, you can be investing with the unit trust as you grow enough muscle to invest now and move your funds to a bond? Because if a bond is 5 million minimum, you can save on unit trust until 5 million, and then you move that money to that bond, right? So these are the fund managers. Go to your bank. Go look for brokers. Go and find information. Me, I'm just sharing so that you can go and do the work. So advantages and disadvantages of treasury bills. The advantages are they are safe and low risk. Yeah, they are safe and low risk. They are best for short-term investments because it's either 3 months, 6 months, or 1 year. So short-term investment, they are predictable profit. I told you they will tell you how much you're going to earn even before the money comes. Okay, yeah, it's low minimum investment, but that's averagely. Who is helping you? Who is your mediator? Your mediator is the one who determines your minimum investment. Then also, it's easy to buy through banks and brokers. Like you don't have to go to sit in the auction they do all that work for you. The disadvantages of treasury bills is that profit is not compounded. So it's simple interest, right? Then also, there are lower returns compared to unit trusts. And I think also it's because the profit is not compounded. There's something about compounding profits. Here, the money that is there is that one. So it's usually lower returns. And I tested that. So because last year was my year of testing, I did unit trust, I did treasury bills. I haven't done a bond yet. But I realized that if I'd invested the money I invested in treasury bills, because I did both. But when I calculated towards if I put this money in a bill, in a unit trust, I would have got more profit. But also we're going to share at the end what determines where you save and why. So these are the disadvantages and advantages. So number 3, treasury bonds. Now, treasury bonds, it's still we are lending government, but this is a long-term loan that you give to government, and it is also issued and auctioned by Bank of Uganda. And the time frame for bonds is 2 years, 5 years, 10 years, 15, 20. And last year, they brought a 25-year bond. I know some of you were hearing that they brought a 25-year bond and you had no idea what they were saying. But they bought a 25-year bond, so you can keep your money longer. Yeah. And profit can range from 10 to 16% a year, depending. Usually bonds have more profit, more annual profit than the longer the investment, really, the more the profit. So characteristics of treasury bonds. Number 1, you can earn regular interest called a coupon during the life of the bond. So your initial investment remains fixed. Yeah, but you get to withdraw your interest usually once or twice a year. So if you've invested 5 million, which is the minimum for the guys who are my brokers, if you invest 5 million and let's say minimum, it's 10% a year. Of course, that would be like 500,000. They will remove tax, do whatever the money, maybe it can come at like 450. Yeah. So sometimes you can get it. The people who choose to get it once, they'd be like, no, I'll get mine for 50 once. Then there's like, no, you can give me 225, maybe at the first time they give, and then the next time I'll get my 225. So it depends. So the bond has a maturity date, and after it expires is when your principal is returned. So your principal will be there for that maturity date. After it expires is when you get it back. So some people, what they do with bonds is that they just keep getting this kind of interest. And it, like I said, that gentleman I told you who is like 83, for him, his principal is there. He lives off his coupon every year. He lives off his coupon every year. Though there are also people who leave it there. And I think there's a new calculation that they do for them when they leave it there or something. I think there are people who also leave it there and they're like, for the 15 years, I'm not going to touch this money. So yeah. So again, go and ask questions. If I choose to leave my money there for 15 years, how is the calculation? What does that look like? Those are things you talk about with your broker. Because when I was doing treasury bills, I made them calculate for me before I invested. I wanted to understand what do I get, how do I get it and stuff. Number 3, you can choose to sell your bond before its maturity. However, you will lose, it may reduce your profit. So because remember you've invested and they are counting on having your money for a particular time period. You can sell bonds, but you can't sell treasury bills because they are short term. Those ones. And also treasury bills, you get all your money at once. There's no coupon for treasury bills. All your profit and all your initial money, you get it at once. But here you can choose to sell. But remember, you've told them you're going to, you've given them your money for 15 years. Then you come after 8 and then you want your money. Of course, that's an inconvenience for them. And there is a way to reduce the profit. Some people even sometimes might get even a bit lower than the money that they invested. Generally, there's some sort of penalty. So also ask questions. What if at the 8th year of my 10-year bond, I want the money? What happens? Go and ask questions. I'm giving you homework. Number 4, bonds earn a simple interest. Same thing as treasury bills. It's not compounded. The one that they tell you get is the one that you get. So the differences between bonds and bills and bonds. Number 1, when it comes to term, short term, the bills are short term. Like I said, 91 days, 182 days, 364. When it comes to the term, then, okay, I had to change this. This had to be bonds. Let me first fix this in a minute. All right. So when it comes to the term for bonds, for them, they are long term, 2 years, 5, 10, 15, 20, and 25. When it comes to interest for bills, interest is paid after maturity. For bonds, interest is paid as a coupon, either annually or semi-annually. When it comes to risk, bills are low risk. When it comes to bonds, for them, it's low to medium. When it comes to use, short-term, bills are for short-term investment, and then bonds are for medium or long-term investment. There are people who I know who have put in treasury bonds, for instance, because they are long-term, and that's the inheritance they are leaving for their children. They have put some money, some 200 million somewhere, and they're like, let it grow. They don't even take back they don't even take the coupon. They're just leaving it to grow there, and they've set it for like 15 years. So that by the time this child is a certain age, there's this amount of money that their child can get. So again, like I said, there are those years of plenty. And if God has blessed you that you're in your years of plenty and you can easily access certain amounts of money, you can start to make more long-term investments that even for your children, for your family, you get. So the advantages and disadvantages of the treasury bonds, the advantage is that they are safe, Number two, they have regular interest, the coupons that are annual or semi-annual. You can use them for long-term planning. Yeah. They also have higher returns than bills because I said that the longer the investment, the more the profit. So they have higher returns. They can even enter 17%. That is wild per year. Then they're also tradable in the secondary market. Like I said, if you're tired of your bond or you need the money or whatever, it's tradable in the secondary market. You just go back to your broker and you tell them that this is it. Then they also have predictable income. You know how much exactly you're going to get. When we go to the disadvantages, number one, profit is not compounded. So what it is what it is. Then number two, if you sell before maturity, you lose money. Sometimes you lose some of the profit. Some people, if they've even really gone earlier, they can even lose some of the principal money. Then number three, lower liquidity. And so selling might not be as easy as bills, but people rarely sell. Okay, people sell bills, but it's really rare because they are short term, really. Why would you want to sell something that's 3 months? It's just 3 months. But getting a buyer for bonds sometimes may take a while, right? When you want to liquidate, it may take a while. That's the disadvantage. So you have to wait on the broker to get someone who wants to buy in that same exact money that you have, and then you get. So yeah. Number four, which is our last investment option, are shares. So a share is a small ownership part of a country, of a company. A share is a small ownership part of a company. So like when you buy a share, you own a piece of that company, however little. Ooh. All right, sorry about that. Power went off. So, okay. I hope you're on. Can you hear me? Can you hear me?
Yes, we
Somebody?
can.
Yes, we can hear you.
Okay. Sorry, we are having power issues. All right, let me go back to sharing my screen. We're almost done, so that's good. Okay, so when you buy shares, you own a piece of that company. And when you buy shares, you have a right to a position of its profits. So when you buy shares in a company, you have a right to their profits. Then also when you buy shares, you can sell the shares later at a higher price. But shares are a high risk investment. And I know that you've heard popularly in circles of usually people talk about shares, especially people who understand what shares are. So how to make money from shares? Number one is the dividends, where companies pay part of their profit to you. Like I said, when you buy shares, you're sort of entitled to some of their profit. So when you buy shares, they can give you dividends. And that depends on how much they've made that year. It depends on so many things, but it's really up to the company. Number two, you make money from shares by capital gains, where you sell your shares at a higher price. So you can buy them. I'm going to give you an example of shares that I bought and I sold early. Now I regret. So capital gains where you sell your shares at a higher price. So you buy them at this price, they increase over time, and then you sell. So where are shares traded? On the Uganda Stock Exchange. So you can buy shares in companies on the USE. Umeme, Stanbic Bank, MTN, whatever, different companies. So how do you buy shares? You open a CDS. This one is a CDS, Central Depository System account with a broker. with a broker. My network is unstable. Oh my God. Okay, you open a CDS with a broker like Crescent Capital, UAP, or brokers affiliated with Stanbic or ABSA. You see those same brokers that you can buy your bills and bonds at, yeah? Not the banks, but the brokers, usually. But you can still talk to your banks. You never know that they are also a broker. That's where you open a CDS, then you choose an amount to invest. So usually shares, the minimum is 100,000. And then they'll place the market order for you to buy. That's how you buy shares. So when you go to these places and you want to buy shares and you open this account, I want you to have conversations with them. Ask them what are the companies that are available to buy shares. Ask them what are the rates, Let's first continue. So the advantages and disadvantages of shares. The advantage is number one, it has a high return potential. They are high risk. The reason they are high risk is because you can buy a share today, for instance, at 12 shillings a share. And then because of market price and economic prices, you wake up tomorrow and it's at 5 shillings. So you've literally lost 6. So it has a high, but also you can wake up tomorrow when it's at 24. So it has a high return potential and it's unpredictable, but it has a high return potential, especially if that particular company is growing properly. Then number two, you can easily liquidate your shares. I bought shares and I sold them in a month. And I'll explain why. And those guys are really laughing at me. They're like, you're the person who has bought shares and sold them in 1 month. We've never seen this. But because I was on a financial journey, I wanted to understand how things work. So for me, I was doing a lot of testing. They laughed at me, but you can easily liquidate even in a day. You can just send them a message or an email or call. Me, for the first times, I will walk into the office because I want to understand things. I was like, so if I want to sell, what do they like? Okay, you just send this on the email, send this order, tell this person. Yeah. Number three, shares are a way to diversify. It can be a way to diversify your investment portfolio. This would have to be investment portfolio. So it can be a way to diversify your investment portfolio. You can have a unit trust, you can have bills, you can have bonds, you can have shares, you can have insurance. Like you can have so many things for as long as you're able to fund those investments. Then also, shares have an inflation hedge. There's a way they tend to grow faster than inflation, so it usually saves the buying power. The disadvantages come in when we talk about price volatility. The same way I've told you that you can wake up when you bought your shares at 12% per share, and then you wake up and it's 5%, and things happened. An example is Umeme. So after Umeme was bought out, the share price dropped. Now imagine people who had bought it at its peak. Let me say, because I haven't checked what Umeme is like today. Let me first see if these guys shared something. Okay, let me see. Umeme is at 241 shillings per share right now. But I did some research and it dropped a bit after the buyout. Now imagine a person, there are people who bought Umeme at 60 shillings per share. Of course, they are still in profit, and the thing about shares, that shares are long term. So shares are not the kind of thing that you buy. A minute. Okay, it's countrywide. Okay. So shares are not like a thing that you buy, and how do I explain this? It's not a thing that you would buy and typically just sell. The whole idea is that buy shares and hold them for as long as you can. So at a time when, first of all, that you can earn from the dividends of the company that they give you, but also from the sell. When you reach to resell, it's worth it. So imagine a person who bought Umeme, let's say when the shares were at 60. Right now it's at 241. So such a person is still in profit. Now a person who, let's say at one point Umeme hit 300 shillings per share. Imagine now the person who bought it at 300 and now it's at 241. So that person lost and is still in losses because they bought it at 300. So the disadvantages with shares is because it has that price volatility and you never know when it's going to happen. That's the thing about shares. So that is why number 2 says that there are no guaranteed returns. You can buy shares and then there are no returns at all. For instance, Stanbic a few months ago, I think in September, was at 62 per share. Right now, it's still at 62. So what if it lasts at 62 for the next 7 years? You get, there will be no return. So you will have invested your money, it will be just there. Number 3, it requires knowledge and research before you step in. When it comes to shares, don't just invest. You have to have do research, ask questions. And then also, short-term losses are possible. Like I said, yeah, it's possible to wake up and you've lost money. Let's say a person who bought Umeme at 300. I don't know if it ever reached there. I'm just giving an example. It's now at 241. They already lost about 59 shillings per share. Imagine someone who put in millions of money. They're at loss, right? Then number 5, making emotional decisions can hurt returns. When you are buying shares, you have to have research. Don't be sentimental. Yeah, we're almost done. So that's why you need brokers before investing in shares. Yes, they give you, they explain to you. So when I went to buy shares, I bought shares in MTN and Stanbic. At the time I bought them, Stanbic was at 62 per share. Right now, it's at 62. I bought at the time, MTN was at 286. So when I went to these people, I had an amount of money that I wanted to buy shares. And so I wanted to use all that money to buy in one company. They're like, no, because it's a bit of a sum. Let us split it into 2, buy in one place and another company, just in case. So I asked them why. Because I ask questions and I love money markets. So I study money markets. I just have a thing for money markets. So I asked them, so if I want to invest right now, where should I invest? And they told me that okay, my network is on and off. They told me that MTN had just is going to diversify and have MTN Momo as its own company, right? Yeah, you're spreading the risk. Thank you so much. So it was getting more what's that thing? MTN Momo. So they told me that MTN is looking like its shares are going to hike because they're also branching out. So ask them questions. Where should I invest and why? What is the prediction? I really stress those gentlemen, my God. Okay, I didn't stress them because we're laughing. Me, I know how to just conversate nicely. But it was a funny when they're like, why not? I was like, yeah, so tell me, what do you think? What do you predict? Because me, I love money markets. I love predictions. I want to understand why. So they told me this. So now I bought MTN at 286 at that time. Remember, I sold my shares in one month, and I'll tell you why. And now, right now, they closed on Friday because they opened on Monday. They closed for the weekend. It closed at 315.83. So I would have been a profit of 29 shillings per share, and that was between September and now. So imagine I had bought shares that were in good millions. I would be having 29, a bonus of 29 shillings per share. So this is how they say that it has a high return potential. Someone told me, those guys were telling me about, I think it was Bank of Baroda. And I think right now they're no longer buying Bank of Baroda. Bank of Baroda reached a point where in like people made a lot of money in a space of 6 months. I don't know what happened. I've even forgotten the figures, but these guys told me at my brokers, but also that gentleman at the Securities Exchange told me that Baroda made a lot of money in like 6 months. That was 2024, must have been 2024. They made a lot of money at that point. So when you ask, now you see, you bought at 160. It's now at 315. So if you're still holding, you have money. You get. So it has high return potential, it's high risk, but if you understand markets, if you ask questions, if you know why things happen the way they, if you understand business trajectory, like you have to also bring your ears on the ground. So yeah, you can make money from that. So I want us to close because these gadgets are going to black out. So how do you decide where to invest? Now, number one, you're going to define your goal. Do you want short, long or short term? This is how you decide. Shares, insurance, and bonds are long term. Like how you've seen Juliet told us that 10 years, what, it's long term. So if you're looking at investing long term, look at shares, look at insurance, look at bonds. If you look at investing short term, look at unit trusts and bills. Those might be more short term. So also ask yourself, what is your risk tolerance? Yeah. Insurance, bills, and bonds have low risk. Then unit trusts have low to medium risk, and then shares have high risk. Okay, these guys used to make this joke that no risk, no Ferrari. If you don't know how to risk high, you won't buy a Ferrari. Okay, it's a joke to me because I understand the setting that we're in. So shares have a high risk. The number three, liquidity. How easily can you access money? So these are three things you look at. What is your goal? What is your risk tolerance? And how easily do you want to access money? When it comes to bills, the money is tied until maturity, both your principal and your profit. When it comes to bonds, apart from the coupons, profits, they actually harder to sell before maturity. You have to wait. It's not like you can pull and be like, let's sell, let's sell. And then you can also lose money. When it comes to unit trusts, you can withdraw within 1 to 3 days. Shares, you can sell anytime, but remember, prices fluctuate daily. Then insurance is locked in for years. So before you decide where to invest, what is your goal? What is your risk tolerance? And how easily do you want to access the money? Now, the reason I sold my shares and I sold the shares and bought a treasury bill is because I didn't want to easily liquidate that particular amount of money. I knew that in that time period, I knew that there was pressure that I would have had for money. I foresaw something was going to come and pressurize me to get this money. And not necessarily that it was an important thing, but if the money was away, they would have been away. So I was like, let me sell these shares and buy a bill instead. That's why I sold them. Then I bought a treasury bill, which is still holding. So the thing that needed money came. I wasn't pressured because I couldn't access the money. And funny money was there to deal with that thing. So that is why I sold my shares. But I'm looking into buying shares this year. However, they will tell you also, talk to these people, talk to these brokers, don't do things in an ignorant way. They will tell you that, right? They'll tell you there are certain companies on the market right now that will tell you that right now they've hit the peak. Don't buy now, like you'll be buying high. The thing about if you've been in money markets, even people who know how money works, even like in forex exchanges, you don't buy high, you're supposed to buy low. So there are some companies, this will tell you that company where it has reached, we don't think that share can go any higher. So you don't buy high, you're supposed to buy low. So they'll advise you, right? Because right now, they might tell you, I'm not sure, but they might tell you that right now it may be a bit tricky to buy MTN. Okay, it can increase, but the higher it goes, the greater the risk, especially you who buys high. Like I said, imagine, for instance, if Umeme reached 300, I don't know if it did. People who bought at that peak, they had to lose because even if you buy low and it reaches a pattern goes a bit down, you don't lose much. Maureen has told us that they bought MTN at 160. It's at 308, 315 right now. Even if it went down to 240, you're still in profit because you bought low. So there's that principle of buying low, don't buy high. So someone is asking, is it a wise financial decision to take a loan at a low interest and then invest the money in bonds? Or I actually don't think it is. In my opinion, I could be wrong, but I don't see why you should get a loan, then invest it. How are you going to be paying it back? Because remember, loans have like, you have a payment plan. How will you be paying it back when this money is for instance, bonds, the money is stuck. It's there, you can't remove it. Then bills, and the interest might be low. I don't think it's wise, to be honest. Okay, you can talk to someone who is like, who can think. Right now, my mind is not really calculating, but the way I see it, I don't think it's a wise thing. And then shares, what if they fluctuate? But also, how are you going to be able to pay it back? I don't think that you should get a loan. Investments ideally should be from saving. Ideally. Yes, now I saw this one. Someone talked about getting a salary advance. I think it was Pumla who shared this. You can get a salary advance from your workplace and invest it. Yes, I saw Pumla talk about this. But a loan, no. So advice for beginners, if you're looking at safety first, invest in bills, in bonds, and low risk insurance. If for you want to keep your money, invest in bills, bonds, and low risk insurance. If you want medium growth, invest in unit trusts. If you want high growth and higher risk, no Ferrari, invest in shares. So that is it. Thank you so much. So more, Maureen was saying, I don't think because it was on loan and bond does not balance as well as cost. Yeah, it doesn't balance. I don't think it's wise to get a loan to buy bonds and bills. Like, there's a way that math won't be mathing. It will be bad debts, like Claudia said, and you'll end up, no. Then, yeah, Galaxy A31 says that you can get an advance. Yeah. The return on investment won't be able to pay the loan as quickly. Exactly. Yeah, the return on investment won't be able to. So salary advance has no interest. So, okay, yes. So you can get your salary advance and then you put that in bill or a unit trust would be better because it compounds. And you just have discipline and you leave it to compound. Yep. So you start with unit trust, you accumulate and invest in TBs. Exactly. That's what I'm saying. So you get the money, accumulate it, invest in TBs. So any one of us can have investment anywhere. First, look where you fall, see how much money you have, see where you can invest. Just don't be there and you have no investment. It doesn't make sense. Doesn't make sense. It really doesn't. So this end of my presentation. If you have a question, please ask. And for those who are not Ugandans, this applies in your country. The terms may be different, but go and Google. Yeah, you have to have a discipline of not withdrawing until your target is met. Exactly. There is something someone said, she's on Bumpler, this other lady, Barbara, who said that for when she's saving money, she usually likes those banks where she can't easily go, where the line is long, where those banks. So what you can do with your unit trust, which I did with mine, I have a bank that has, I think, only 2 branches in Kampala, 2 ATM branches. No, there are 3, but they are so far apart. So I'm always lazy. Because I start to calculate now, I go, 1 branch is in Wandegea, the other branch is in Ndeba, and the other branch is the main branch over it is the other side, like Garden City, over where those ends. So I start to be like, then I just leave the money there. So also endeavor to invest more than you spend. Exactly. Save, invest more than you spend. If you guys, do we have any questions? If we don't, let's close this. Let's close this. Let's close this. Okay.